Have you ever wondered how global real estate companies strategically position themselves in the market? Well, today, we're diving into a fascinating acquisition that highlights just that. Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. In a significant move, Hines, a global real estate company, has acquired the Junction 27 retail park in Bristol, United Kingdom, on behalf of the Hines Global Income Trust. This acquisition is a part of their strategy to diversify geographically and by real estate sectors, adding to their impressive £3.4 billion portfolio. The retail park, fully leased and spanning 131,000 square feet of net rentable space, features tenants like Currys and SCS, emphasizing the site's robust sales and high foot traffic. According to research by Hines, retail parks are currently outperforming traditional shops in terms of occupier demand. This acquisition marks HGIT's entry into the United Kingdom retail market, highlighting the company's focus on stable assets with strong long-term income and growth potential. Alfonso Monk, President and Chief Information Officer of HGIT, noted the importance of having local expertise and being selective, particularly in key locations like Junction 27. The site's strategic location in the Bristol cluster, one of the United Kingdom's premier retail districts along the M62 motorway, offers connectivity to major populations in Leeds and Bradford. Supported by strong demographics and an IKEA shadow anchor, Junction 27 benefits from robust sales and long-term tenants, making it an appealing asset for Hines. Hines, known for its extensive experience in investments across the risk spectrum and all property types, continues to be one of the largest and most respected real estate organizations worldwide. With this acquisition, they further solidify their reputation as a leader in the real estate market, leveraging evolving market dynamics to their advantage. Trepp and CRE Direct have recently highlighted a potential turning point for the office sector in the first quarter of 2025 quarterly data review. As the commercial real estate market enters a period of transition, the insights provided by Trepp, a leading provider of data, insights, and technology solutions, along with Commercial Real Estate Direct's editorial expertise, offer a comprehensive analysis of the commercial real estate finance and commercial mortgage-backed securities markets. Amid economic uncertainty fueled by new administration policies and the potential impact of trade tariffs, signs of renewed momentum are surfacing. The report reveals a surge in commercial mortgage-backed securities issuance, shifting office real estate investment trust strategies, and signs of pricing stabilization across key property types. Orest Manzi, managing editor of Commercial Real Estate Direct, notes that while the office sector continues to suffer from lackluster demand, resulting in historically high vacancy rates, there might be hope on the horizon as real estate investment trusts begin to eye office acquisitions and developments. The magazine also details that office property prices ticked up slightly in the fourth quarter of 2024, though they remain 20.35% below their 2022 peak. Some key takeaways from the first quarter of 2025 include a 110% year-over-year increase in commercial mortgage-backed securities issuance to $45.8 billion, fueled by single borrower transactions and increased lender confidence. Additionally, office real estate investment trusts saw a 7.8% increase in average leasing volume, driven by strategic repositioning in Sunbelt and secondary markets. According to Trepp's Property Pricing Index, property prices ticked up 0.76% in the fourth quarter of 2024, hinting at potential stabilization. However, delinquent commercial mortgage-backed securities loan volumes rose to $39.26 billion, led by new distress in multifamily and hotel properties. The report also points out the looming risk of General Services Administration lease termination, with over $2.7 billion in federal rent, subject to early termination options through 2028. Despite the challenges, there is cautious optimism as some investors perceive that the market might have reached a bottom, especially for older buildings. With smart money beginning to look into buying or developing anew, the quarterly data review further explores key insights for commercial real estate professionals navigating 2025. In the world of commercial real estate, the true measure of success is not found solely in occupancy rates or rent rolls. It lies in the lasting value a property commands, both today and tomorrow. Gerst Property Management has demonstrated how strategic management practices can significantly elevate an asset's market value beyond its initial appraisal. With more than 2 decades of experience in property and facilities management, Gerst Property Management has prepared 2 commercial plazas for a successful sale to a development firm in 2022, showcasing the importance of proactive, strategic management. The foundation of increasing property value begins with operational excellence. Often overlooked, seamless and well-documented property operations are critical. Routine maintenance, predictive repairs, energy efficiency upgrades, and professional building presentation directly contribute to higher tenant satisfaction and lower turnover. Properties with comprehensive maintenance records, regular capital improvements, and demonstrated cost control consistently attract higher valuations, instilling confidence in both buyers and tenants. Tenant-centric strategies are key to building a property's competitive advantage. Happy tenants create stable revenue, longer leases, and stronger community reputations. Gerst Property Management emphasizes creating an environment where tenants thrive, which includes responsive service, flexible lease structures, and amenity enhancements that exceed expectations. Such strategies have played pivotal roles in maximizing perceived and real value for potential buyers, as demonstrated in their recent transactions. Future-proofing assets through modernization and adaptability is another major driver of value. Properties that embrace modernization, such as sustainability initiatives, smart technologies, and adaptable designs, outperform aging assets. Small investments like LED retrofits and energy management systems can significantly enhance a property's market positioning. Gerst Property Management's commitment to modernization has helped secure competitive offers and smoother due diligence processes, aligning with environmental, social, and governance standards. Strategic financial stewardship is essential to optimizing the financial structure of a property. Regularly reviewing expenses, renegotiating service contracts, structuring leases with escalation clauses, and improving net operating income make properties more attractive to potential buyers. Gerst Property Management has shown that consistent financial discipline can present buyers with not just a building, but a high-performing investment vehicle, substantially elevating the property's value. One of the most valuable lessons from managing and selling properties is the importance of maintaining sale readiness as a permanent state. Regular inspections, updated compliance documentation, fully executed lease agreements, capital improvement schedules, and clean financials make transitions seamless. Properties that are always ready command premium prices because they present fewer uncertainties to buyers. Gerst Property Management's disciplined, strategic management has attracted serious, qualified buyers quickly and resulted in strong deals in a competitive market. At Gerst Property Management, the understanding is clear. Value is not something waiting to be discovered. It is something to be built, one decision at a time. In today's commercial real estate landscape, strategic management practices are not optional. They are the foundation on which durable, long-term property value is created. Those who understand this and act on it every day will have properties that stand out, endure, and outperform in any market. In Southern California, industrial real estate is experiencing a noticeable shift as asking rents continue to decline amidst ongoing uncertainty. According to a report from CBRE, asking rents in the greater Los Angeles area industrial market have decreased by 7.7% quarter over quarter and 13.8% year over year. This trend marks the 9th consecutive quarter of negative absorption, with 7 of those quarters, including the first quarter of this year, experiencing negative net absorption of approximately 2 million square feet or more. Landlords and brokers are contextualizing these declines as a correction from the rapid rental growth seen during the pandemic era. However, broader economic uncertainties, such as recent tariff policies, are presenting challenges for property owners trying to predict future tenant demand. This uncertainty is making tenants hesitant to commit to leases. B.J. Turner, Chief Executive Officer of Dunleer, notes that while his portfolio of small and mid-bay industrial properties has not yet seen significant rent softening, there are tangible impacts. Although rent escalations are not as aggressive as in previous years, Turner is confident in finding tenants. He also highlights the local effects of a slowdown in the entertainment industry, which has led to decreased demand for prop warehouses and related industrial spaces. Patrick Barnes, a principal at Avison Young, anticipates that rental declines will continue until there is clarity on tariffs and their economic impact. He projects that rents could soften between 10% and 20% this year, due to the need to absorb existing inventory. Extended uncertainty and a holding pattern among decision-makers could pose significant challenges if they persist. Comparatively, in the Kitchener-Waterloo, London, and Cambridge areas of Ontario, industrial real estate has shown resilience. While facing similar economic uncertainties, these regions have maintained stable rent levels, partly due to strong demand from technology and manufacturing sectors. Cross-border, this stability offers a contrasting perspective to the fluctuations seen in Southern California, highlighting the diverse impacts of economic conditions on industrial markets. Metro National and Radom Capital have officially broken ground on the highly anticipated Memorial City expansion, located north of Interstate 10 in Houston, Texas. This significant development marks a new chapter in the evolution of the Memorial City area, positioning it as a vibrant community hub. According to the Houston Business Journal, this collaboration between Metro National and Radom Capital is a first for the two companies. They are transforming 35,000 square feet of warehouse space at 1085 Gessner Road into a space that is set to become a cornerstone of the community known as Greenside. The project aims to create a dynamic retail center that will feature a mix of first-to-market retail, restaurant, and service tenants. With a focus on innovation and community engagement, Greenside is expected to attract both locals and visitors, enhancing the area's appeal as a destination. Michael Hausu, Office of Architecture, is leading the design of the project, ensuring that the development reflects the latest trends in architecture and urban planning. The vision for Greenside emphasizes a blend of modern design with community-centric spaces, fostering a sense of belonging and interaction among visitors. This development is part of a larger trend in commercial real estate, where developers are increasingly focusing on creating mixed-use spaces that not only serve as shopping destinations, but also as places for community gathering and social interaction. As such, Greenside is poised to become a hallmark of the Memorial City area, setting a precedent for future developments. The Memorial City expansion reflects a broader strategy seen across the United States, where developers are reimagining traditional retail spaces to meet the evolving needs of consumers and communities. This approach aligns with the growing demand for experiential retail environments that offer more than just shopping. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.